We've got David Forrester with us. He's Vice President of Global Forex Strategy at Barclays Capital. He joins us now live from Singapore. Good to see you, David. So the euro down by just 0.1% over the week against the dollar. How come we haven't seen it move more to the downside?
Thank you for having me, Lindsay. Well, there are a few reasons. First of all, we have got a bailout mechanism in place and it's been tested twice already. On top of that, we have the EU leaders, at least in principle, agreeing to increasing the bailout capabilities of the EFSF to 440 billion euro. So the Portuguese bailout, when it or if it eventually comes, won't be too much of a strain. And finally, we have to remember that the real story with the euro at the moment, and particularly euro dollar, is a divergence in policy between the ECB and the FOMC. And that's a pretty strong underwriting strength of the euro dollar at the moment.
So you've got that rate hikes driving the euro, but do you think that investors are also now betting that these bailouts are going to stop with Portugal and they're not going to move on to Spain?
That's a very good question, because that is showing up in the peripheral bond spreads relative to bunds. You see that Irish bonds are still blowing out their spreads relative to bunds. Of course, Portuguese bonds are blowing out relative to bunds, but we're not seeing that in the case of Spain, and we're not seeing the same contagion that we've seen previously. And that's another reason that the euro has taken on that little bit of I guess, Teflon attitude towards recent volatility in the peripheral area.
What changes that scenario? Could a protracted negotiation with Portugal, it's got to get a new government probably before it can negotiate a bailout with the EU. Also, EU leaders, you say they've agreed in principle, but they still haven't come up with anything concrete. Where is that comprehensive plan?
They're very good questions. In terms of what could change it, well, if we do get, say, Germany blocking the expansion of the EFSF, that would certainly change it. If we had say the ECB backing away from its hawkish stance, which is unlikely. And finally, if there were protracted negotiations with Portugal and potentially the mention of haircuts to private bondholders, which is unlikely at this stage, that would also change things, because that would then raise the risk of contagion to other economies. If we start getting private sector bond haircuts or private sector holders haircuts to sovereign bonds, then where does that stop? It won't just stop with Portugal.
You say that the ECB is unlikely to back away from its hawkish stance, but a rate hike is not going to be a good thing for these peripheral nations that are struggling so much.
Well, we see that we have current upstream inflation pressures on top of the already aggravated or high inflation rate in Europe, and that's being added to by high energy prices. So that will see the ECB likely hike in the near term. But we agree, and our economists think, that the market is probably a little bit aggressive in looking for 3 rate hikes this year. We think the ECB is looking probably to only do 2, and one of the reasons for that is the large fiscal contraction that's coming through, which is part of these the conditions of these bailout packages.
David, very quickly, where do you see the euro going next? I mean, could it reach 150? Is everybody going to sell after we get this first rate hike?
Well, we have to remember there are 2 sides of the equation here. First of all, we expect US economic data to surprise to the upside. That's going to be good news for the dollar going forward. And as I mentioned earlier, those 3 rate hikes are too aggressive for the ECB. So we do expect some pullback towards the into the high 130s.
All right, David Forrester, thanks very much for being with us.